Good morning, everyone. I'm John Kogan, the CEO of Proformative, the online community for corporate finance, accounting, treasury, and related professionals. First, I would like to welcome everyone to the webinar, Raising Capital and Creating Currency, Characteristics of a Successful IPO. As a 20-year veteran of finance and accounting and a 4-time CFO, I know, as everyone in the audience does, that there is no more seminal event in the life of a company, its investors, certainly its finance and accounting team, than going public. This event is our attempt to bring you insights from those who live this process on a fairly regular basis and are well positioned to help us all understand how to prepare for and successfully execute an IPO and then thrive in our post-IPO world. I would like to thank our sponsors who have made it possible for Proformative to bring you this program. They are The Heights and Stifel Financial, two companies steeped in how to succeed in today's IPO market. Today we will hear brief presentations from our two speakers. They are Phyllis Proffer and Dave Chanley, and then we will spend the remainder of our 1 hour in an open panel discussion. We would like this to be an interactive experience for you, so if you have any questions at any time, please go to the questions area in your GoToWebinar control panel and send us your questions. We can't promise to get to all of them, but we will do our best. If there are questions that remained after the fact, we will do our best to get them answered and sent back to you or posted directly onto Proformative. We will be offering 1 CPE credit for the CPAs in today's audience. Please send an email to twalsh@proformative.com in order to receive your CPE certificate. That's twalsh, W-A-L-S-H, @proformative.com. Okay, without further ado, I'd like to get started. And to that end, I would like to introduce our first speaker, Dave Chanley. Dave is Managing Director in the Electronics and Applied Technologies Investment Banking Group of Stifel Financial. For more than 14 years in investment banking, Dave has worked closely with clients on over 100 completed transactions, including exclusive sales, cross-industry mergers, restructurings, and domestic and cross-border M&A for companies such as Agilent Technologies, E-Ink, JDSU, and many, many others. On the financing side, David has advised clients on numerous IPOs, equity, and equity-linked transactions. He joined Stifel Nicholas Weisel in connection with Stifel's acquisition of Thomas Weisel Partners in 2010. Prior to joining Thomas Weisel Partners, David was an investment banking associate at Montgomery Securities and a research associate at Greenwich Associates. David earned a bachelor's degree from Brown University. We could not have a better person to help guide us through the complex maze that is the IPO process. It's a pleasure to have you here. Dave, please take it away.
Great. Thanks very much, John. So as John said, it's Dave Chanley here from Stifel Nicholas Weisel. Just to add to what he said, I have spent 15 years in investment banking and have completed over 50 IPOs, primarily in the technology sector. So turning to the first slide, on slide 4 here, why would a company consider going public? Well, several reasons. Number one, first and foremost, is to raise capital. Your options as a private company are to continue raising private capital, which at times can be expensive and valuation hard to communicate. Raising capital through the public markets is one way to accomplish many objectives. And so the first one, of course, is raising capital, as I mentioned, strengthening the balance sheet by adding cash, using the cash proceeds of the IPO to pay down debt, invest in the business, whether it be capital expenditures, acquiring additional equipment, hiring new people, opening a new location, expanding your sales and marketing team, or also to make acquisitions to further the scale of the company. Creating public currency is another benefit of going public. The ability to establish a market value for the company enables a private company who may be interested in selling at some point to have an established price on the company or value on the company, which the public dictates in more of an efficient market. And if you were to sell the company in the future, if that was the right thing to do for shareholders, typically you'd receive a control premium for that. The ability to make acquisitions and to use, in addition to cash, stock or equity-linked securities, whether it be convertible securities or preferred stock. It gives you much greater flexibility to do that. Creating liquidity, the insider shareholders or the founder of the company may be able to sell in the IPO or have the ability to sell after the company is public by selling stock to the public markets. Enhancing employee incentives, whether it be putting in a stock option plan or restricted stock units, really creates a retention tool for employees, incentivize the employee base to take a lot of pride in their company and have a vested interest in the performance of the company to see the stock go higher. It's certainly a branding event, and Phyllis will talk about this a little bit later in her presentation, but really increasing publicity and market awareness, the opportunity to tell your story to investors and then have your story publicly available for anyone who wants to learn about it. And you've seen that in recent IPOs that we were a part of, whether it be Primo Water that we just did a month ago as the book runner. I noticed I was in a Ritz-Carlton a month ago. I'd never really heard of Primo Water, and next thing you know, you see them at multiple hotels. Or SodaStream, another IPO we did a couple of months ago. There's advertisements now, and it's one of the hotter Christmas gifts this year. The opportunity to really create excitement around the company's growth opportunities and capture investors' imagination. The ability to establish an attractive shareholder base, hopefully a long-term ownership base, and again, Phyllis will speak to that a little bit later, but attracting the capital from institutions and mutual funds who want to own their stock for a long period of time, and may add to their position over time, and hopefully that certainly is the intention, and hopefully the outcome of the IPO, but a much more stable shareholder base that if you want to sell your stock, you can sell it because there's a public market for your stock every day. And lastly, gain effective Wall Street sponsorship. There will be several investment banks on the cover of your IPO or underwriters for the deal, and typically it is investment banks practice to launch research coverage on the company as a service to their institutional clients and put price targets on the stock once they take it public. There are issues associated with going public. I mentioned all the advantages and benefits on the left-hand side and just described all of those. Some of the issues to consider in going public is that you're now accountable to public shareholders. And you may have heard of Sarbanes-Oxley or Section 404, where the CEO and CFO have to give a public attestation of the financials. And if someone wanted to take over the company and offer a high price for the company, even though the CEO or the founder may not want to sell, they have to listen because they are now accountable to public shareholders. Public disclosure requirements would increase dramatically. Sensitive information, whether it be revenue by product segment or geography or revenue with top customers, the compensation of executives or even perks of executives that you might have enjoyed as a private company, all needs to be publicly disclosed. In addition, the quarterly report card becomes critical, where the street or investors are looking for how the company performs on a revenue and earnings per share basis each and every quarter and want to know what the outlook is for the future. And then certainly it's expensive to go public. Anywhere from $1 to several million dollars required to be a public company, whether it be for directors insurance or SEC filing fees, investor relations staff, or a broader finance team, or to put Section 404 or to be compliant with Section 404 and Sarbanes-Oxley. And then lastly, it certainly can be distracting, and it's a time-consuming process. The overall IPO process can take longer than a year, and certainly the last 6 months leading up to the IPO can be pretty intense interactions with bankers and lawyers, and then getting ready to go public. There are balancing interests between the issuer and the investor, so the company that's going public, and then the investor that is interested in buying the stock. The goal of the issuer is to minimize their ownership dilution, and so selling a smaller portion of the company, or as small of a portion as they can, so they can retain as much ownership as they can, and really that comes to maximizing the value of the company. And so, for example, If you did a $50 million IPO at a $200 million market cap, you would have sold 25% of the company. Whereas if you were able to get a valuation because the market dictated of a $300 million market cap, that $50 million IPO would only be 16% of the company. And so the value that you hold on to would be certainly much more valuable. You need to position the stock for price appreciation. You will have granted probably options to your employee base at the market price, and so you want that stock to be poised to go higher so that they continue to be incentivized and excited about the company they work for. And of course, I mentioned placing the stock with long-term holders to try to really avoid investors that do quick flipping and create volatility around the stock. Wall Street research and coverage support so that there's a resource out there for projected financials, price targets, and highlights of the company and also potential risks. And then liquid aftermarket for shares. Shareholders and large institutions want to be comfortable that if they're putting $1 million or $10 million into the company by buying the stock, that they can easily get in and out of the stock. So liquidity is pretty important so that it reduces the risk for institutional investors. And then, as I mentioned earlier, raising the company profile. The investor demands, they want to see stock price appreciation. Of course, they buy the stock, they want it to go up. And so they look to invest in high-quality growth opportunities, so companies that have done well historically, but more importantly, are expected to do well in the future if they're holding their stock. And so hopefully, from the investor standpoint, the IPO is priced at a fair point relative to its peer group or potentially a slight discount and feel like it have the opportunity to continue to go up. Access the management team and research. Again, Phyllis will touch on this a little bit later, but be available and accessible to the institutional investor base, whether it be attending conferences or doing non-deal roadshows. It's important for investors to have a good understanding of what they're invested in. I mentioned liquid market for shares. I think that is an objective for both sides. And then flawless execution by the underwriting group. Investors will hope that the IPO is priced appropriately, that the book is allocated appropriately, so there's not a lot of flippers in the stock, and that the stock doesn't decline by, say, 15% or something like that after it's priced. And from the issuer standpoint, in terms of investment banking, underwriting, execution, you also don't necessarily want the stock to go up 100% right at the IPO because it means maybe you priced it too low. Flipping to the next slide here, what are the traditional IPO benchmarks? Well, as an investment banker, we look for companies that have several characteristics that can be successful as a public company. Number one is really a large visible market opportunity, something that investors can understand. It's tangible, it's growing and large. The opportunity for the company to have a unique or differentiated offering that enables it to gain market share in a large and expanding market. Number two, kind of a demonstrated ability to realize that market opportunity. So in other words, the company is proven. It's already got strong revenue growth. It's got high-quality customers, appears to be a very sustainable business model, which demonstrates that the company has the ability to take advantage of the market opportunity in front of them. Stability of revenue. The products, so a wide array of products or diversification. Customer concentration can be an issue. Hopefully there's a diverse set of customers so that you're going public without one major customer, because in the investor's mind, if you lose that customer, that is a huge risk and would negatively impact the stock. Clear competitive differentiation. Investors don't want to invest in me-toos, particularly at the IPO. If there's another company that's larger, that has all the opportunities, the same market opportunity, but is proven as a public company, they could easily just buy that stock. So as a new debut issuer, it's important to communicate what your differentiation is and why you can grow faster than some of the public companies that may already be out there. Experienced and proven and recognized management team. I'd say less so on the recognized side, but certainly experienced and proven. Proven would be the results historically of the company and how it's performed, gives investors confidence in a new company as it becomes public for the first time. Highly respected financial and strategic investors. If the company that's going public does have strategic investors or venture capitalists or private equity firms, hopefully they have a quality track record and a track record of investing in high-quality companies and are responsible with regards to how they handle their stock. They don't just sell stock openly in the market, that they do it in a very efficient and responsible manner, and also don't do a great deal of financial engineering utilizing debt or recapitalizations, that they're good quality companies that have a long-term view for their portfolio company. And then business infrastructure to realize their market opportunity really is the ability to scale. You may be in a great market that can grow. You might have a proven track record that you can grow, but can you grow further and faster? Do you have the ability to do that and the scalability, because that is going to lead to a higher stock price. In terms of the IPO environment and understanding what is the right timing to go public, first of all, the economic environment. Are stocks generally cheap or are they expensive? Can you get public? And some great companies like Starbucks, for instance, went public during a recession. The market performance, are the indices going up? Are they going down? What's the volatility? Mutual fund flows and equity fund cash positions. Is there money going into funds, meaning that personal or individual investors are looking to put money into the market? If these mutual fund managers have more capital, then they're more willing to buy IPOs. The backlog of initial public offerings, is it crowded? The characteristic of recent successful IPOs, do we have some of the characteristics that other recent deals have done? Revenue growth versus profitability. Certainly in 2000, all you needed was a .com next to your name to get public. Nowadays, you need to have demonstrated revenue growth and a strong path to profitability. The next page here, IPO market statistics 93 to present. What's pretty striking here, as you'll see, is that the number of IPOs have come down dramatically over the last 17 years. So in the 90s, it was approximately 600 IPOs per year. Nowadays, if you do 200 IPOs in a year, it's considered a great year. So in the 04 to 07 time frame, so down by a factor of 2/3. The aggregate IPO proceeds, however, have remained roughly consistent in the sort of $30 to $50 billion range per year. And if you look at the 99-2000 time frame, it's really more of an aberration. So if the dollar amounts in terms of proceeds are being invested in the IPOs and the number of IPOs are going down, then certainly on the next page you'll see here the median IPO size has gone up. And so where you used to see routine IPOs in the $30 million or $50 million zone in the 90s, now you're seeing IPOs that are rarely below $100 million a year. And therefore, the median market cap on the bottom of the slide there, we're now over $350 to $450 million per year. So what does that mean? The takeaway is that you need to be larger today to go public. And there's been lots of press out there that perhaps that has been a real negative for our overall economy because it's more difficult to get public, but that is the reality. That is what the market bears right now. And unfortunately, the bar is higher for a company to go public. On the next slide, which you see in 2000, the IPO market was driven primarily by tech and biotech, whereas over the last 9 years, it's been pretty well distributed. So again, that 2000 time period where so many companies went public, it really was an aberration. And today, pretty well balanced, and that balance is pretty reminiscent of what the S&P 500 looks like today from an industry perspective. On the next page, I touched on some of this, the requirements for a successful IPO. We talked about the large and growing market opportunity, historical and projected revenue growth, track record of profitability. We're on a clear path. What I mean by that is you don't necessarily have to be profitable or have to have had 8 straight quarters of profitability as long as you're growing fast. If you're growing fast and the market understands that you have operating leverage in the model, then if you're going to go profitable in the next couple of quarters, you can get public, particularly in a good IPO market. A little known fact is that 40% of NASDAQ companies are actually unprofitable on a GAAP basis. In terms of valuation considerations, the size of the IPO discount, the size of the IPO is typically 25 to 35% of the overall company. So a $500 million market cap company might go public with a $100 to $125 million IPO. And at a $125 million IPO, the pre-money value of that would be about $375. Competing asset classes, also an important consideration in terms of valuation is money flowing into high-yield asset class or debt because yields are high, or in the equity market if valuations are low. Perhaps some investors don't want to take on the risk of an IPO. But the key really to timing is how successful are IPOs being received, because investors always want to flow money to where the better returns are. So if IPOs are working, and they are right now, then they are more willing to be receptive towards an IPO. Advanced preparation, the key thing here is to build a network of experienced investment bankers, lawyers, and accountants, and people that are experienced in your industry, because every industry is different. Technology is very different from oil and gas, as an example, and what it takes to go public is very different depending on what your specific environment is for your business model. You should develop and maintain a detailed projection model because you want to establish a track record of financial performance versus the budget. And Phyllis will talk about that because it becomes predictability, and you certainly don't want to get in the penalty box with institutional investors because you missed your projections or mismanaged expectations for the street. Key steps in the IPO process: due diligence, drafting sessions, roadshow prep, responding to SEC comments, and the roadshow, and then pricing and closing. Really, the due diligence and drafting sessions is the preparation of the S1 document, which is the key document to market the IPO. And the investment bankers will need to do due diligence, as well as the lawyers, to make sure that investors feel comfortable in investing in the company. And a lot of that all goes into the S1, where everything is disclosed about the company. The roadshow preparation is also done shortly thereafter, where the CEO and CFO get ready to pitch the business to investors, and they need to keep it to less than 30 minutes. So our job as an investment banker is to make it very crisp and concise. The SEC will comment on the document to make sure the proper level of disclosure is there. We would put the preliminary valuation range on the cover. It's usually a $3 range or $2 range, so 14 to 16 as an example, where it could be priced at $14, $15, or $16. And the roadshow is done after that, and I'll show you a timetable on the next page. And the final step is that roadshow, and at the very end of that roadshow, the IPO is priced by the investment bankers, and it's really driven by the demand shown by institutions. I mentioned the IPO timeline, and you can see it here on slide 15. The preparation phase is typically about 5 weeks, and I say typically, it's sort of rule of thumb, but it can certainly take much longer than that. And the advanced preparation is many months before that, and Phyllis can talk about that. When you're ready to do your organizational meeting, you really want to be ready to keep it in 5 weeks. You file your document with the SEC. While you're waiting for the SEC to respond, they usually respond within 30 days. You should be preparing your roadshow presentation with your bankers and be in a position to do the roadshow, which usually takes about 2 weeks, and pricing. So all in, about 16 weeks to do the IPO. The final page here is to demonstrate that that may be the plan, but that may not always be the case. As you can see here, the median number of days from initial filing to offer has expanded from about 50 days in the mid-90s to now over 100 days, and that really is due to the SEC's growing scrutiny during the S1 review process. So that concludes my portion of the presentation. John?
Thank you very much, Dave. That was excellent. A lot of fantastic information there, and very well delivered. Thank you for that. Just a quick note before I introduce our next speaker. I've got a bunch of people asking whether they can get a copy of the slides, and the answer is absolutely. In fact, we will email you a copy of the slides within the next 24 hours, and they will also, of course, be posted on Proformative. Also, for the late arrivals, we are offering 1 CPE credit for this. Please send an email to twalsh@proformative.com, and I'll say that again more slowly at the very end of the event. And at this point, what I would like to do is introduce our next speaker. Next up is Phyllis Proffer, founder of The Heights. Phyllis has more than 30 years of business experience, primarily dedicated to managing relationships with the financial community as the internal investor relations executive for a number of publicly traded companies of various sizes in diverse industries. She has broad experience in maintaining shareholder confidence through a range of acquisitions, divestitures, turnaround situations, and the introduction of entirely new management teams, as well as spin-offs, bond offerings, and convertible preferreds. Phyllis earned a bachelor's degree from Southern Illinois University, a master's in communication from St. Louis University, and an MBA from the Fuqua School of Business at Duke University. Phyllis, please take it away.
Well, thank you, John. Okay. So, as a new issuer of common stock, you will have the opportunity to build your brand with the investment community from scratch, beginning with the IPO Roadshow. I've learned over time that the two greatest attributes of that branding will be management credibility and your company's reputation. Your company is proven in the markets it serves, and a similar image will evolve with the financial community. The same market dynamics that drove your business before issuing shares, such as competitive threats, changing customer needs, governmental regulations, etc., still exist. However, your response to those changes will now be in public view. So my comments today are focused on helping you build and maintain a great brand with the financial community, including the tools companies use to measure and manage their relationship with investors as efficiently and productively as they manage the rest of the business. Here are 4 basic goals common to most strategic investor relations plans, regardless of a company's size or industry. First and foremost is maintaining access to capital markets on the best possible terms. Properly valued stocks reflect the company's prospects for growth. They attract attention from investors and create an interest in knowing more. Management has credibility with the street, and the company enjoys a good reputation. Existing and prospective investors have a very good understanding about the company's investment characteristics and are making knowledgeable decisions about buying and selling the shares. The company is creating communications that promote sound investment decisions, which means full disclosure of thoughtful, comprehensive, timely information. There is continuity in the communication offered in order to avoid inaccurate perceptions that could inadvertently mislead investors. The liquidity and volatility reflects how well the company has satisfied the 3 goals I just discussed. Investors buy and sell shares based upon expectations for future financial performance. You want to develop your strategic investment messages built upon reasonable expectations that your company can achieve in a realistic time frame. Predictability supports credibility and reduces stock price volatility. Decide early what operating and financial metrics you want to share with them. Provide proof points for your investment messages. Offer updates on a regular basis. Providing data only when it is good and avoiding reference on the same data when it is negative doesn't build credibility and doesn't increase investor understanding of your company's operating performance and financial results. So let's talk about investment messages before moving on to communications. Here's a few of the major elements of investment messages to help you articulate the characteristics for your company. How would you like investors to measure your success, track your performance, or progress toward a corporate goal and strategy? Be strategic and avoid giving competitive information that could hurt your company in the long run. So your ability to compete. Why do customers come to you rather than the competition? Sales and revenues may not accurately reflect your ability to compete. So here's your opportunity to add a couple of metrics. Sales growth trends. What are the drivers? As examples, is it market growth, share growth, And is that based on unit growth, market expansion, product or technology innovation? You want to quantify this. Productivity. How do you convert sales into earnings? Talk about your expenses and gross margin and anything else it takes to generate sales. Earnings growth. Is it sustainable long term? As examples, is it organic or is it dependent upon mergers and acquisitions? And how are you going to fund that growth? So talk about your balance sheet and cash flow. And controls. Do you have the necessary controls in place to lower the risk of surprise and pursue earnings growth? So we're talking about predictability. Keep investment messages in front of your prospective investors by maintaining consistency and timeliness in all communications, from industry events to media interviews. Company-generated information is only one resource for investors to learn about the company, which means you will want to eliminate any noise that may detract from or dilute your investment messages or unintentionally mislead investors. This is where disclosure policy and quiet periods can help align the entire organization toward this goal. Maintaining a predictable schedule for releasing earnings and scheduling conference calls indicates control over the quarterly close and reporting process. Announce the impact of material information as soon as it is known. Delivering negative news as swiftly and deliberately as you deliver positive news builds credibility. Avoid being overly promotional. It doesn't attract the investment styles that could increase demand for your shares without causing wide swings in the stock price. That's volatility. You want to achieve a more orderly market. Be prepared to contrast and compare with others in your industry. The financial community will do this, and you have the opportunity to help them appropriately position your company. You need to know what other companies are doing. 1 to 2 years in advance of your IPO, there are several things you can do. It's a good idea to establish a consistent practice of modeling your future financial performance. Dave talked about this quite a bit, and I'll talk about why that's important. This is a study that the National Investor Relations Institute completed last July. It's now common practice for companies to provide guidance to the financial community. The results of this survey reflect good representation of all sizes of companies and industries. 90% of the companies surveyed provide some form of guidance, and I've shown the top 6 in order of priority. Companies are not required to provide guidance, but it is common practice. Unless you can be accurate in your guidance, don't do it. It's not worth risking your credibility. The first step, of course, is to develop the financial reporting and modeling discipline, and then you can determine the frequency of the updates on the financial metrics that make the most sense for your company. Also, 1 to 2 years in advance of your IPO, you'll want to establish consistent practice of corporate communications and product announcements. Communication is cumulative. Websites, product announcements, news releases, or any customer-oriented material generated by your marketing department before and after the IPO will be used to gain a better understanding about your company. And most investors expect senior management to have as much control over this as any other facet of your business. 1 to 2 years in advance of the IPO, create a flow of information and approval process. Clearly define roles and responsibilities, and it's also a good time to develop your disclosure and media policies. Start building the brand by establishing name recognition and industry visibility well in advance of issuing shares. This will provide a historical perspective once the shares begin trading. 6 to 12 months in advance of the IPO, start monitoring your peer group. Investors will compare the financial performance of companies offering similar products and or services. So it's beneficial for you to become familiar with the information your peers provide. Start listening to their earnings conference calls. Review their SEC filings. You also want to become familiar with how stocks trade within your peer group and what, if any, external news may influence trading, volume, and stock valuation for the group. Is there a discernible pattern? Which sell-side analysts are publishing research on your peers or industry? Who should be on your target list for the initiation of research coverage once your shares begin trading? It is helpful to know the key dates for financial reporting of your peer group when developing the financial reporting calendar for your company. I highly recommend you do this for the first full year after the IPO. It will help avoid calendar conflicts and help calibrate the entire organization toward the new responsibilities of being a public company. You'll also want to educate employees about the responsibilities of being a public company. There's a typical exchange of information when dealing with vendors and or customers, trade groups, etc. You don't want to hamper normal business operations, and you don't want to risk someone disclosing material information. So you may need to help employees determine what is and isn't appropriate information to share. Employees can also be a great representative for your strategic investment messages. Incorporate position or branding statements into employee communications, and you'll find they'll start using them in conversations with outsiders with whom they conduct business. Consistency in communication. Investors need to hear the same message more than once. Here's a list of the communications that will exist after you issue shares that didn't exist before. Use every opportunity to emphasize your investment characteristics and provide quantifiable and measurable proof points. Let's talk about a natural progression of creating and updating this list of material. Starting with Roadshow. It's significant because it is the first impression you will make, your first opportunity to introduce your investment messages and demonstrate effective management style and skills. Your investment bankers will make sure the presentation is professional, and you'll want to rehearse and prepare for Q&A. Add to the Q&A as you meet with prospective investors. Once your shares begin trading, incorporate what you've learned from the IPO process. Use this information to create communications around your first quarterly earnings release. Start with the news release, just the facts. Add color for the conference call script, and then incorporate both into your 10Q, because that will be the most lasting and accessed documents for information about your quarterly financial performance. Don't bury data in the 10Q without mentioning it in the news release and conference call script. Stocks will trade on the news release and again after the conference call. Time is money. Each quarter, update the slide deck. The first quarter you do this, it'll be from the IPO Roadshow. And then you'll add your quarterly information each quarter and update your Q&A document every quarter as well. Even if you do not have an impending investor conference, you will use the updated slide presentation as a discussion document for one-on-one meetings with investors. Incorporate all of your quarterly information into your annual. Strongly suggest a shareholder letter regardless of whether you do an annual report or a 10K wrap. Opportunity for the CEO to provide the company's vision, strategy, and accompanying management board changes or changes to operations, systems, structures, etc. Update the slide presentation and Q&A document that you've been using all year. Most of the items presented here will appear on your website. You will archive conference calls and conference presentations rather than provide the actual scripts. All of the news releases and SEC documents will be on your website as well. And it's grown in popularity. The websites have grown in popularity. This is a study by Revell Research Group, and it's based on interviews with about 250 buy-side investment professionals. Was done the first half of 2009. And you can see here the growth and the importance of websites to the various becoming aware of a company and also in making that investment decision and also keeping track of that company after they purchase shares. It's important to be accessible to the investment community. It's an opportunity to learn more about their investment styles and turnover characteristics. Listen to their feedback. It's a wonderful resource for building and refining your investment messages, and it's also an opportunity to clarify your investment messages and correct any misperceptions. You'll want to get to know your top 10 or 20 institutional investors, depending on your number of shares outstanding. This will become increasingly important under the Dodd-Frank Act. The demands on your time will be great, and that's why it's important to target institutions with investment styles that match your company's investment characteristics. Common mistakes are to spend too much time with the wrong investor or spend too much time with the sell side at the expense of time you could be spending with the buy side. Here's the importance of management accessibility, and you see for small cap companies that 71% of the respondents said it was very important to meet face-to-face with senior management before making an investment decision. Don't assume that person that you're meeting with is as prepared as they should be or want to be. The closer you get to the top of the pyramid where the buy and sell decisions are made, the more generalists you will meet. This diagram here, on the lower portion of the diagram are analysts. On the right side are the sell-side analysts who work for brokerage firms such as Stifel Nicolaus Weisel and publish research on companies. Sell-side analysts are knowledgeable about a particular industry and or sector and typically cover most, if not all, of the companies in that sector. They're specialists, if you will. On the opposite side of this diagram are analysts that either serve as the research staff of the buy side by contract or sell the research they publish to a number of institutional investors. They're frequently called independent research because they're not associated with only one single institutional investor or brokerage firm. They may not follow every company in a particular sector. The center represents the buy side. There are analysts who conduct research within the institution, typically generalists. Frequently, particularly at smaller firms, the same person combines both roles as analyst and portfolio manager. The top of the pyramid are portfolio managers who make the buy and sell decisions. They're predominantly generalists. And back to targeting. You want to develop a targeting and prospecting plan for increasing interest in your stock by the institutions who could increase demand for your shares without causing wide fluctuations in the volume or price. These are your quality investors, and they'll help you create an orderly market for your shares. So I have the descriptions on the slide. You can read this to save some time because I do want to allow for questions. There are two types of funds that are not on this slide. There's a growth at reasonable price. That's a hybrid that's somewhere between growth and value. Also, there are quant funds, and those decisions are made by the financial models the quant funds have created, and very little is based on the management or the fundamentals. Similar to index funds, they're not likely to meet with management frequently. So let's move on to, we've talked about being accessible to investors, the reasons why, seeking a good match with the investment styles and your investment characteristics. Let's talk about managing your relationship with the sell side. You need to be objective, not complacent about sell side coverage. The investment opinion is their opinion. You should look for areas to correct inaccuracies or misperceptions, but that information may not change the investment opinion. They typically follow entire industries or sectors, which means earnings season is difficult as they try to absorb, analyze, and publish quarterly earnings information for a number of companies simultaneously. It's a perfect storm. They are rushed and you are rushed. Mistakes happen but are easily resolved with a phone call. Institutional investors frequently discount information provided by a brokerage research analyst if it is too positive or too negative. There is a safety in numbers, and the peer review I talked about at the beginning of my prepared remarks will help you determine and prospect brokerage research coverage for your peer group or industry. The sell side can be very helpful in introducing you to prospective investors by asking you to present at investor conferences or coordinating non-deal marketing trips after your shares begin trading. Do not delegate who you meet with to the sell side, because their clients understandably come first. They may not have the investment styles that match your investment characteristics. Work collaboratively to develop a list of institutions with whom it makes sense to meet based upon the targeting you've performed. On these last two slides, once again, monitor your progress. We've talked about all of these items, so you're going to want to look at how many conferences you attend, small group meetings that you do, one-on-one meetings. Look at your shareholder mix, daily trading volume and stock price, the accuracy of your research coverage. Go back to the 4 goals I talked about at the beginning of this presentation and see if the liquidity and volatility truly reflect the value of your stock and what you've shared with the financial community. And then measure your performance relative to your peer group, and also report regularly to your board of directors. And that concludes my prepared remarks, and I think we still have 15 minutes for Q&A.
Yes, that was great. Thank you very much, Phyllis, for that. Let's go ahead and move into the panel discussion. Now, as a reminder, if you have a question that you would like to have answered by the panel, and I can see the number queued up already, please ask it via the questions area in your GoToWebinar control panel. Let's go ahead and kick off with this question first. Dave, we'll hit you with this first, and then go to Phyllis next for comment. What is the single clearest sign that your company either is or is not ready for its IPO?
It's size and predictability. So are you large enough to have the float that you're looking for? So an IPO of at least 50 million, and that's going to be dependent on what the value is for companies that are similar to you.
Great. Phyllis, any comments on that?
Absolutely. It's the predictability.
Size and predictability. Great. Next up, how, from the CFO's perspective, or the financial leadership perspective, and that's an awful lot of the folks who are on the line today, how important is it to have previous IPO experience in order to have a successful IPO as a CFO?
This is Dave. I would say it's not mandatory, and certainly anyone can take a company public, but it certainly is helpful. It has built-in credibility with potential investors, and certainly having the experience to manage the whole process leading up to the IPO is certainly helpful and allows it to be much more meaningful. But I'm working on, we'll probably do 6 or 7 IPOs this year, and I'd say at least, that's just in my sector, I'd say at least 5 of those 7 have CFOs that were not public CFOs before.
That's interesting. Phyllis, any comments on that?
Yeah, I'm not. I agree with Dave, by the way. I don't think it's a determining factor of the success of the IPO. If the CFO has worked with a company and maybe started out in public accounting, worked as a controller, now CFO, whether it's a private or public company, it really relates to the ability to predict future financial results, and that begins with accurate financial reporting. So if the CFO totally understands about proper staffing and systems to meet SEC requirements for efficient close, efficient internal control environment to comply with Sarbanes-Oxley, that leadership is probably, that leadership internal to the financial organization is probably more meaningful than having experience with previous IPOs.
And Phyllis, actually, just to continue on that theme, what have you seen, especially in all of your experience with publicly traded companies and companies that are in the process, what's the best way for finance leaders to prepare for this?
You're going to want to talk to public accounting firms who can help you set up the structure and really are completely up to date with the changes in the regulatory environment and what that may mean. So you're relying on previous experience, you're networking with people in the field, and the people that deal with this all the time with public companies. And once you get with your attorneys and your investment bankers, tell me, Dave, if you agree with this, it's a formula that's used for the IPO process. So you're in really good hands in terms of issuing those shares, and then be very strategic about how you're going to manage those relationships, monitor your progress, set goals for yourself in terms of what you want to achieve by being a public company after those shares are issued.
Totally agree, Phyllis.
Dave, being the person who's at the tail end of that process, and you pick up companies when they're really ready to go public, what are the areas that you've seen CFOs be least prepared for that our audience could benefit most from having visibility to?
Oh, I think as Phil said, some of the things that makes a CFO successful after going public, it's the ones that are unsuccessful, the ones who are not prepared. And for me, when we're doing due diligence on a private company and assessing whether or not it's ready to go public, the biggest issue we typically face is, do they have a good model or system in place that helps them forecast? And it doesn't need to be forecasted out 5 to 10 years, but at least the next year, and in particular over the next couple of quarters. So do they have a track record of how they forecast, of getting input from the sales force, understanding what the competitive dynamics are in their particular market, what kind of market share they have, how fast they can grow, and then having a good handle on the expenses. The expenses are something that the CFO should have a very strong handle on with a great deal of predictability. And if the track record isn't there when we're doing financial due diligence, it may cause us as bankers, when we're pricing it, to be more conservative and work with the management team and take their numbers down a bit, which can result in a lower valuation, and of course is not what everyone desires. So I think the most important takeaway here is build a track record of proper budgeting processes, and then demonstrate that that track record is that you typically meet or exceed that budgeting process, and that therefore your budgeting process is deemed to be successful.
Well, that's an interesting perspective, and we actually have a related question here, or somewhat related. And the question is, does it matter what kind of technology a company uses, whether it's for forecasting or planning, or their ERP systems, or other systems? Do investors care about that, or is it just results?
This is Dave. It's more about the results. To us as investment bankers, right, we're sort of the last stop, if you will, before it goes public. And so the institutional investors assume that the investment bankers are very comfortable in their due diligence, that the company has what it takes to go public, and therefore is willing to put their name on the cover and actually underwrite it. To me, it's all about confidence, or the systems. When we ask for maybe the forecast at one point in time, and 6 months later, does it come out in the same format? Is it the same type of data, the integrity of the data? So whether it's a very inexpensive Oracle ERP system, or whether it's some homemade system or some customized system, as long as it's consistent and the auditors feel very comfortable that the data has a high degree of integrity, then we get comfortable.
Phyllis, what kind of board members should companies look for, either immediately pre-public or post, and what is the best place to find them? So what are the criteria they should have, backgrounds, and what will you find most effective?
That is an incredibly timely question, because there are changes forthcoming in governance issues. And when you look at what do they bring to the table, you're going to include the biographical information of each board member you have. So what do they bring to the table? And does it really advance the enterprise? Are they good counselors to the management team? There are going to be some changes in say, on pay with shareholders. There are going to be some changes about requirements for the independence of board members and the independence of committees and what committee actions are. So anybody looking at an IPO now, I'd say the implications are transparency in all matters. Executive compensation is a hot button. Board independence and accountability is a hot button. There's going to be heightened exposure for board committees and more active interaction with shareholders, or should be. So for IPOs to look at the selection of board members, very important. So first question is, what do they bring to the table? How independent are they? They need to be completely independent from the management team and from the company. And do they, the third variable, do they really add to the composition of the board to advance the enterprise? Is that helpful?
Great. That's right on the money. Thank you. Dave, how do you and your firm, and I'd say the industry in general, see the IPO market shaping up for 2011?
We feel pretty good about it. This year, and you saw probably some of the statistics that I flashed earlier in my prepared comments, is the strongest year that we've seen since 2007, which is no surprise since we've been through a terrible recession through 08 and 09. So we're on par to do, we think we'll do about 200 IPOs this year. That would put us back in the same zone of where we were between the years of 04 and 07. I will say that it's extremely volatile, and the economic data is much more important than it typically is. The election was an important catalyst this year, and there was a lot of companies waiting to see the results of that. We feel good about 2011. In fact, the pipeline has grown quite dramatically, and so I'm aware of lots of companies that are on file and ready to launch their IPO right after the new year. So I would expect that next year would likely exceed the number of IPOs that we had done this year. So hopefully back in that 200 zone. I don't think we're going to get back to the 600 zone that we had in the 90s. But as far as over the last decade, should be a relatively strong year.
And what are you seeing in the market as appetite for China-based companies in the U.S. market?
Well, that's a great, very timely question. There were two IPOs priced yesterday, the day before, from China, more internet-related. One is sort of the YouTube of China. Those stocks were up over 200% from their pricing. And I mentioned earlier in my prepared comments that that doesn't necessarily mean that one of the takeaways is potentially it was priced too low, but it also shows how much demand there is, because even if the pricing was going up, it shows a tremendous amount of demand. And the reason for that is there's just a massive market there, and the growth is tremendous. And so there's a very high percentage of deals that are either domiciled in China or have major operations, whether it be manufacturing or other, that are based in China. So I think that trend will continue into 2011.
Great. Thank you very much. That is all the time we have for our questions. We still have a couple of questions left, and what I will do is work to follow up on those with Phyllis and Dave, and we will get those out on Proformative. I would like to thank Dave Chandler of Stifel Financial, and Phyllis Proformative of the Heights for their time and their great insights this morning. Thank you very much, both of you. And as I mentioned, we will send out soft copies of this presentation to everyone on the line. Certainly a thanks to the audience for their time and attention this morning. It was great having you on board, and hopefully you found this valuable. To that end, we will be sending out a survey to everyone who attended, and we'd love to know what we can do better next time. We're always interested in improving what we're doing. If you are interested in CPE credit for this event, please send an email to Walsh, Tanya, TWALSH, at proformative.com in order to receive your CPE certificate. With that, we are precisely at 9:30 Pacific time, 12:30 Eastern, and we would like to bid a final thanks to everyone, and have a wonderful week and holiday, and we look forward to having you back again in the near future. Thanks to all.